Deciding when to claim Social Security is one of the most important decisions you will make regarding your retirement. And for many people, it can be one of the most difficult too. Does it make sense to claim early, but get a lower amount for the rest of your life? Or should you delay to ensure that your benefit is the highest it can possibly be? It's a tough call. Oftentimes, people will consult a trusted financial advisor on the matter. But is that the right person to ask? Might the advisor have some inherent bias that may make them more inclined to recommend you claim early, regardless of whether or not it's the right decision for you? That's what we're going to explore today. What might your advisor's bias be when it comes to claiming your Social Security benefits? How can you try to identify it? And what are the four things you can do to help make sure you make the decision that is right for you? Hi, my name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize their taxes as they transition to retirement. I release new videos weekly, so if you enjoy this content, please hit like or subscribe, and you'll be notified when the videos are released. Before we discuss your financial advisor's potential bias, let's set up the general framework as it relates to claiming Social Security. Americans can generally claim Social Security between the ages of 62 and 70. For most future retirees, 67 is considered full retirement age. Full retirement age means you'll receive 100% of your primary insurance amount. If you claim at age 62, you'll receive 70% of your primary insurance amount. If you wait until age 70, you'll receive 124% of that amount. Let's put some numbers to this. For example, let's say you will receive $3,000 when you hit full retirement age. If you claim at age 62, your monthly benefit will be $2,100. If you wait until age 70, the monthly benefit will be $3,720. Now, this is admittedly an oversimplified scenario as we are ignoring the time value of money and how that may affect the benefit over time, but it does help illustrate the difference in the monthly benefit amount. Also, you do need to keep in mind that you are foregoing 8 years of benefits if you wait until age 70 rather than collecting at age 62. So a separate analysis may need to be completed. I'll have more on that later. So now that we know the general framework, why might our advisor be conflicted or have a bias when we ask them for their opinion on when to take Social Security? Number one, slower asset drawdown if you claim early. Many financial advisors earn a fee based upon the assets they manage. The greater the amount of assets, the higher the fee. Encouraging you to claim Social Security early might allow them to structure your portfolio differently, potentially preserving more assets for them to invest. For instance, if you're drawing less from your investment accounts because you're receiving Social Security income, those untouched funds remain under the advisor's management and continue generating fees. And if you have alternative income sources like rental or pension income, the early Social Security proceeds may be deposited into your investment account, further increasing the amount of assets your advisor manages. While this isn't inherently bad, it raises a question. Is the advisor prioritizing a steady revenue stream over your long-term financial plan? Number two, using a simplified rule of thumb. Rules of thumb, like claiming Social Security age 62 to reduce portfolio withdrawals, can be appealing for their simplicity. However, these rules rarely account for individual circumstances such as personal longevity, spousal benefit maximization strategies, and income tax implications. An advisor might suggest taking benefits early to make planning easier for them. But this approach could leave money on the table for you, especially if you expect to live into your late 80s or beyond. Number three, avoiding complicated calculations. Advisors are often managing multiple accounts, each with unique retirement scenarios. Running detailed Social Security analysis for each client may be time intensive. Instead, they might default to recommending an early claim just to make it easy. But simplification can come at a cost to you. Number four, demonstrating immediate value. Advisors may feel pressure to demonstrate immediate value to their clients. Recommending you take Social Security early provides a tangible, immediate benefit, cash in your pocket that you can begin using today. It's an easy way for advisors to appear proactive and helpful. However, this short-term win might overshadow the long-term impact on your financial security. For married couples, the higher earning spouse delaying benefits can maximize survivor benefits, an essential consideration for those spouse who may outlive them. Okay, now that we've identified these four potential biases, what are the actions we can take to make sure our financial advisor advice is truly in our best interest. Number one, ask for a detailed analysis. Request a comparison of how claiming Social Security at different ages affects your overall retirement income, including taxes and longevity considerations. Number two, consider a second opinion. If you feel pressured to claim early, consult another financial professional. A fresh perspective can help clarify the best course of action. Number three, understand the assumptions. Advisors use software and tools to model Social Security scenarios, so make sure you understand the assumptions behind their recommendations, such as life expectancy or market performance. Number four, check your advisor's credentials. Look for advisors who are fiduciaries, meaning they're legally obligated to act in your best interest. Now, please don't get me wrong. I'm not trying to tell you that your advisor is doing anything wrong by suggesting you take Social Security early. It may, in fact, be your best option. But make sure that you understand the calculations and the assumptions and agree that it does make the best sense for you. I did two separate videos on why you may want to claim Social Security early or delay. I will leave links to those videos in the description below. If you're trying to decide what the best strategy is for you, you may want to watch these videos. As discussed earlier in the video, we do need to keep in mind that we are foregoing 8 years of benefits if we wait until age 70 to maximize. So how do we account for this lost income? One way is to perform a Social Security break-even analysis. This analysis helps us calculate how long you will need to be collecting Social Security at the higher rate from delaying claiming versus taking the benefit early. It's a very important analysis to understand. I did a previous video on how to do a break-even analysis, and you can find a link to that video here. If you've made it this far, thanks for watching. If you enjoyed this content, please hit like and subscribe. Thanks again for watching, and I'll see you next time.